If you own gold, if you own silver, if you own Bitcoin, or honestly, even if you just own a normal index fund in your 401 kilobits, one man just did something that either saved your year or completely wrecked it. And most people watching this still don't understand which one it was. In real time, in a single trading session, gold had its worst day in over 40 years. Silver got cut in half. Bitcoin fell off a cliff below 80,000 and then kept falling past 64,000. Trillions of dollars of value just disappeared. And the wild part, this wasn't a war. This wasn't a bank collapse. This wasn't some crazy black swan nobody could have predicted. This was one nomination, one name, one pick for a job. Most people can't even tell you what it actually does. By the end of this video, you're going to understand exactly who this guy is, why the market panicked the second his name got announced. And I'm going to give you the exact three-step way I think about protecting yourself when the rules change overnight like this. Because they just did. Before I go any further, I got to be straight with you. And what I'm about to walk you through, the stuff about how the Fed actually works, why gold and silver got smoked, why Bitcoin isn't the safe haven everybody sold you on, this is the kind of breakdown people pay real money for. I'm giving it to you free. All I ask, hit subscribe right now before you keep watching, because I'm not doing this to build some audience for ads. I'm doing it because most people get their financial education from people trying to sell them something, and I'd rather you hear it straight. So subscribe, then let's get into it. Okay, so here's who we're actually talking about. His name is Kevin Warsh, and if that name doesn't mean anything to you yet, it will by the end of this video. This isn't some random pick out of nowhere. This guy was a Federal Reserve governor back in 2008 during the actual financial crisis. He was in the room. He watched the system almost collapse. He watched the Fed panic and start printing money like there was no tomorrow. And here's the thing people miss. Everybody who lived through that has an opinion about it. But this guy has spent the years since telling anyone who'll listen that he thinks the Fed made a mistake letting money get too loose for too long. He's on record over and over saying he wants tighter policy, higher real interest rates, and a smaller Fed balance sheet. Translation, in plain English, less easy money floating around. Now, why does that matter so much that it can crash 3 completely different markets in one day? Because the Fed basically has 2 buttons and only 2. Button 1 is keep people employed, keep the economy moving, keep money cheap and easy to borrow. Button 2 is keep prices under control, keep inflation from running wild. Here's the catch. Nobody explains to regular people you can't really push both buttons hard at the same time. Push the easy money button too hard, prices start running away from you. Push the tight money button too hard, you slow the whole economy down, maybe even tip it into a recession. For the better part of 15 years, going back to right after that 08 crisis this guy lived through, the Fed leaned on the easy money button almost the entire time. Rates near zero. For years, trillions printed, and every asset that benefits from cheap, easy, flowing money. Stocks, crypto, gold as an inflation hedge, all of it got used to swimming in that pool. So when the news breaks that the next person running the Fed is a guy who spent a decade publicly saying, I think we did too much of that and I do less of it, the market doesn't wait around to find out if he's serious. It repriced everything instantly. That's why I keep telling people, the market isn't reacting to what already happened. It's reacting to what it thinks is about to happen. This wasn't about one speech or one number. This was the market looking at 15 years of the old playbook and saying, that playbook might be getting thrown out, and we're not waiting to find out the hard way. And look, I get why this feels confusing if you're not deep in this stuff every day. One guy, not even confirmed yet, just nominated, and markets around the world start shaking. But that's exactly the point I want you to sit with. The person running the Fed has more influence over your bank account than almost anyone else on the planet. More than most CEOs, more than most politicians. And the vast majority of people have no idea who's in that seat or why it matters. That ends today. Because once you understand the 2-button problem, you'll never watch a Fed headline the same way again. Now let's talk about what actually happened to your gold and silver. because this is where a lot of people got blindsided the hardest. Gold and silver are what people in the business call safe haven assets. The pitch you've probably heard 100 times is simple. When everything else is falling apart, gold holds its value. It's been money for 5,000 years. It doesn't answer to any government. And when the dollar looks shaky, people run to it. That story is mostly true, but it's not the whole story, and this event proved it. Here's what actually drives gold higher. Most of the time, it's not fear by itself. It's the combination of fear plus loose money, plus a weak dollar, plus low or falling real interest rates. Gold doesn't pay you interest. It doesn't pay a dividend. So when interest rates are low, holding gold doesn't cost you much in lost opportunity. But the second real interest rates start heading higher and the dollar starts getting stronger instead of weaker, that whole equation flips. Suddenly holding an asset that pays you nothing looks a lot less attractive compared to just parking your money somewhere. That pays you 6% safely. That's exactly what happened here. The moment the market believed this new Fed pick means tighter policy and higher real rates, the dollar spiked. And when the dollar spikes hard and fast, gold and silver, priced in dollars, get hit from two directions at once. Direction one, the opportunity cost of holding a zero-yield metal just went up. Direction two, a stronger dollar mechanically makes gold and silver more expensive for buyers overseas. So demand pulls back right when everybody's already nervous. Silver got hit even harder than gold. And that's not surprising if you followed silver for any length of time, because silver trades with way less liquidity than gold, and less liquidity means bigger swings in both directions. When silver runs, it runs harder than gold. When it falls harder too. That's just the nature of a smaller, thinner market. People treat silver like gold's little brother and forget the little brother throws bigger tantrums. Here's the part that really matters for you. Though a lot of people who bought gold and silver over the last couple of years did it purely as a fear trade. They didn't understand the mechanics. So I just walked you through, they just heard inflation, money printing, the dollar is going to collapse, and bought metal as a hedge without a plan for what happens if the underlying story changes. And the underlying story just changed in one single afternoon. That's not a flaw in gold as an asset. Gold's been around for 5,000 years. It's not going anywhere. The flaw was in how a lot of people were holding it. No plan, no understanding of what actually moves the price, and no answer for the question, what would make me sell this? When you buy something for a reason you can't explain, you have no way to know when that reason stops being true. That's exactly what got exposed here. Now let's move to the one that probably hurts the most people watching this video right now. Bitcoin. For the last several years, Bitcoin has been sold to an entire generation of investors as digital gold. Same pitch as the metal. Limited supply. No government can print more of it. A hedge against the dollar losing value. A safe place to park money when the world gets shaky. And for a while, especially when it was ripping to new highs above $125,000, that story felt true. People stopped asking hard questions when the number just kept going up. That's how it always goes, by the way. Nobody questions the thesis on the way up. But here's what actually happened. The moment this new Fed pick got announced, Bitcoin didn't act like gold. It didn't even act like a hedge. It acted exactly like a risk asset, exactly like a leveraged tech stock, and it fell hard, first below 80,000, then keeping falling below 64,000 within days. That's a drop of nearly half its value from the highs in just a few months. Why would a supposed safe haven crash right alongside the riskiest parts of the stock market instead of alongside gold? Because Bitcoin, in practice, trades like a bet on liquidity. When money is cheap and easy and flowing everywhere, risk assets go up together. Tech stocks, crypto, speculative names, all of it. When the market suddenly believes money is about to get tighter and harder to come by, all of those same assets get sold together too. Bitcoin has a hedge story attached to it, but its actual trading behavior, especially in moments of real stress, has looked a lot closer to a high beta tech stock than to gold. There's another piece of this that made the fall so much faster and so much uglier. Leverage. A huge amount of money in crypto trading isn't just people buying and holding coins. It's people borrowing against their positions, using derivatives, running leveraged bets that amplify every move in both directions. When prices start falling and a lot of the market is leveraged, exchanges start issuing margin calls, forcing people to sell just to cover their positions whether they want to or not. Those forced sales push the price down further, which triggers more margin calls, which forces more selling. That's called a liquidation cascade, and it's brutal because it has nothing to do with anyone's actual opinion about the future value of Bitcoin. It's mechanical. It's forced, and once it starts, it feeds on itself until the leverage gets flushed out of the system. On top of all that, there's a psychological piece that made this worse. The government made it pretty clear it wasn't going to step in and prop up crypto if things got ugly. No rescue plan, no safety net. None of the too big to fail energy that some investors had quietly been counting on. So when the panic started, there was nobody promising a floor. And markets without a floor fall faster because everyone's trying to get out before the next guy. Now here's the thing I want you to really sit with. None of this means Bitcoin is worthless or that the underlying technology doesn't matter. That's a completely separate conversation. What it means is that the story a lot of people were sold Bitcoin protects you when things get scary just got tested in real time. And for this event, at least, it failed the test. It behaved like risk, not like insurance. If you bought it believing it would behave like gold in a test crisis, you just learned something important about what you actually own. Let's zoom out for a second, because gold, silver, and Bitcoin aren't the whole story here. They're just the most visible casualties. What really happened is bigger than any single asset. The market just got a preview of what it looks like when 15 years of an easy money playbook potentially comes to an end, layered on top of an administration that's been rattling markets with tariff threats, attention with other countries, and general uncertainty about what comes next. Stocks around the world got shaky too. Markets in Asia had trading pauses triggered by how fast things were moving. That's not normal. That's a market that genuinely doesn't know what the rules are going to be for the next few years. And here's the piece almost nobody talks about clearly enough. The market hates uncertainty way more than it hates bad news. Give the market bad news, it can price in a rate hike, a weak jobs report, whatever, and it adjusts and moves on. But tell the market we genuinely don't know what monetary policy is going to look like going forward. We don't know how independent the Fed is going to be from political pressure. We don't know if the next chair is going to cut rates to please the White House or hold the line on inflation. And the market does what it always does when it can't calculate the odds. It sells first and figures out the math later. That's what you watched happen. Not one crash. A repricing of risk across basically everything at once, because the ground underneath the whole system just shifted. There's also a question sitting underneath all of this that most headlines skip right past. How independent is the Fed actually going to stay for decades? The whole point of the Fed was that it's supposed to sit outside the political fight, making decisions based on data and long-term stability instead of whoever's sitting in the White House at the moment. That independence is exactly why investors around the world have trusted the dollar and US debt for so long. The second the market starts wondering whether the next Fed chair is picked because of political loyalty instead of monetary judgment, you get a different kind of fear. Not fear about one rate decision, but fear about whether the referee is still calling the game straight. That kind of fear doesn't show up and disappear in a day. It lingers, and it shows up in how currencies trade, how foreign governments think about holding US debt, and how nervous money moves for months, not hours. That's part of why this felt so much bigger than one guy got nominated for a job. On top of that, layer in everything else going on around the world at the same time. Tariff threats bouncing back and forth, tension with other countries, protests, and instability in a handful of regions. And you start to see why the market didn't treat this as an isolated event. It treated it as one more log on a fire that was already burning. When you get a stack of uncertain things happening at once, instead of just one, investors don't sit there and calmly analyze each one separately. They do what scared money always does. They pull back from anything that feels risky and pile into whatever feels safest at that exact moment, even if what feels safest keeps changing week to week. So now let's get into the part you actually came here for. What do you do about it? I'm not going to tell you to buy this or sell that, because anyone telling you exactly what to buy in a moment like this either doesn't understand what just happened or doesn't care whether you get hurt by it. What I'm going to give you instead is a 3-step framework, the same basic discipline that separates people who survive moments like this from people who get wiped out by them. And it applies whether you're in metals, crypto, stocks, or all of it. Step 1, know your actual thesis for owning something, not the marketing version of it. Before this happened, if you own gold, could you have explained in your own words exactly what makes gold go up and what makes it go down? If you owned Bitcoin, could you explain why mechanically, not emotionally, but mechanically, its price moves the way it does? Most people can't. They own things because a headline scared them, or a friend told them to, or the price had already gone up and they didn't want to miss out. That's not a thesis. That's a hope. And hope isn't a strategy. If you can't explain in 1 or 2 sentences why you own something and what would make that reason stop being true, you don't actually have an investment. You have a guess with your money attached to it. Step 2, and this is the one that separates amateurs from professionals every single time. Decide when you're going to sell before you ever buy. I've said this 1,000 different ways over the years, but it never stops being true. Every serious trading desk, every hedge fund, every professional investor I've ever respected has one thing in common. They have selling rules. And they set those rules before they put money into the position, not after. It's already down 30% and they're panicking. Ask yourself right now, honestly, do you have a selling rule for everything you own? Not a vague feeling, an actual rule. If it drops to this level, I'm out. If it hits this target, I'm taking some off the table. If the underlying reason I bought this stops being true, I'm gone. No matter what the price is doing, most people don't have this. Most people's selling strategy is, I'll know it when I see it. And that's exactly how people end up holding something all the way down while it's crashing, or panic selling at the exact bottom the day before it turns around. Both of those are what happens when you don't have a plan. The plan has to exist before the fear shows up. Because once the fear shows up, it's too late to think clearly. Step 3, size your positions for chaos, not for calm. This is the one people skip the most. When markets are calm and everything's grinding higher slowly, it's easy to get comfortable, to put more of your money into fewer bets, to lever up a little, to feel like the good times are just the way things are now. But calm periods don't last forever. They never have. And moments like this one prove it every single time. If a single overnight announcement, one nomination, can knock nearly half the value off an asset in a matter of months, or wipe out decades of gold's reputation as a safe haven in a single day, that tells you something important about how much uncertainty is actually baked into these markets, even when things feel quiet. Size your bets like, that's true because it is. Don't put yourself in a position where one surprise announcement can wreck your entire financial picture. That's not caution for the sake of caution. That's just respecting how fast things can change because you just watched it happen in real time. Let me give you a real gut check for this one. Ask yourself if whatever you're most heavily invested in right now dropped 40% by next week, would that be an inconvenience, or would that actually change your life? If the honest answer is that it would change your life, wreck your retirement timeline, mess up plans you've already made, then you're not sized for chaos. You're sized for a calm world that just showed you it doesn't exist anymore. That doesn't mean go to cash and hide under the bed. It means take some chips off the table on your biggest, most concentrated bets and make sure no single headline can do more damage to you than you're actually willing to absorb. The people who got hurt worse in this move weren't necessarily wrong about the long-term story on gold or crypto or whatever they owned. A lot of them will probably end up right eventually. And what hurt them was being so overloaded in one direction that they couldn't survive the short-term chaos long enough to find out if they were right. And I want to say one more thing about all 3 of these steps together, because they only really work as a package. Knowing your thesis without a selling rule just means you'll hold something all the way to zero, convinced you're right an entire time. And having a selling rule without proper position sizing means you might get stopped out of something good because you had way too much money riding on it and panicked early. And sizing your bets correctly without understanding your thesis just means you're being cautious about something you don't even understand in the first place. You need all three working together. Know why you own it, know when you'll sell it, and know how much of it you can actually afford to be wrong about. That's not some secret formula. That's just what disciplined money managers have been doing forever, quietly, while everyone else is chasing headlines. Here's what I want you to walk away from this video actually understanding. This wasn't really a story about one Fed nominee. It was a live demonstration of exactly what happens when the assumptions everybody's been operating under for 15 years suddenly get called into question. The old playbook, easy money, low rates, a Fed that would always eventually step in and rescue the market, that playbook might genuinely be ending, or at least changing in ways nobody's fully priced in yet. And whether you're holding gold, silver, Bitcoin, stocks, or just a boring retirement account you haven't looked at months, that changes something about how you should be thinking about risk going forward. So here's your challenge. Go look at whatever you own right now, today, not tomorrow, today, and ask yourself the two questions I gave you. What's my actual reason for owning this? In plain words, and what's my rule for when I sell it? If you can't answer both of those clearly, that's not a them problem. That's not a market problem. That's a you problem, and it's fixable starting right now. Drop a comment and tell me what you're holding: gold, silver, Bitcoin, stocks, whatever it is. And tell me honestly whether you had a selling rule for it before you watched this video. I read every single one, and if this actually helped you see something you were missing, don't just scroll past it, hit subscribe, because there's a lot more where this came from. And I'd rather you hear this stuff straight from someone who isn't trying to sell you a product while they explain it. And I'll see you in the next one.